Hi, I'm Kevin McPartland, Head of Market Structure and Technology Research at Greenwich Associates. Today I'm here with Rob Haddad, Vice President of Evaluated Services at Interactive Data.
Good to see you again, Kevin.
Good to see you as well. Liquidity has been one of the hottest topics in the fixed income market over the past several months, and it continues to be a hot topic. Regulators, investors, dealers are all focused on liquidity. What it means, is it good, is it bad? And that's what we're going to talk about today. So let's start with the big question, Rob. What is liquidity? We talk about it so much, everybody's concerned about it. It's gone all the way up to Congress at this point. So can you tell us what is liquidity? What does that really mean?
Yeah, from our perspective, when we think about the fixed income marketplace in general, we don't observe the same level of trading activity that you might tend to see in the equity markets, where it's directly observable. What we think about when we're analyzing the fixed income markets is how we can estimate the ability to liquidate a position without dramatically moving the market price, which is a challenging thing to do when you don't have all that directly observable information. So it becomes really important for us to leverage our data sets and analytics to form a view on that projection of future tradability.
So there's been a lot of research out there trying to understand, is there really a problem? What is the problem? Where is it coming from? You hear folks talk about bid-ask spreads over time, what market impacts are, to your point. So what Interactive Data has some sort of real smarts around how they calculate liquidity and understanding liquidity. Can you explain a little bit about how that works and what you've done?
Sure. It's been a couple of years R&D effort, to be sure. And from our perspective, as I was referring to, it really is important to incorporate the market analytics that we do have and that we do observe in the fixed income marketplace. For over 30 years, we've been evaluating fixed income securities, providing opinions of value as to what a seller in the marketplace would likely obtain from exiting that position. Through those data sets, we incorporate a viewpoint on historical price trends. So in one aspect, estimating a projection of volatility is really important, estimating a projection of that future uncertainty in price. On the other side of it, when we think about price impact, it's really estimating a potential trade volume capacity. Where we don't have directly observable trade volumes, we need to estimate what that potential to trade could be. And so devising an approach that is really well thought out around sensitivities of certain factors and whether there is a certain issuer effect or sector effect or time since issuance or the size of the issue, all of these factors have an input. And they have a certain sensitivity on the future tradability of a security.
So from that output, what is the trader or what does the portfolio manager take in? What are they viewing? And how can they be confident that what you've calculated is in fact correct?
Yeah. So there are a number of elements that are part of the liquidity indicators data set. It starts with a price impact ratio, which provides a viewpoint of the dollar volume traded versus the price uncertainty. So if someone were to trade a single dollar of the instrument, how much potential price impact would they observe? At the same time, we use that information to then rank order securities into various categories. So we'll analyze a security's liquidity profile versus the entire asset class, the entire universe of fixed income securities, that particular security's sector, that particular security's issuer, and it provides a multidimensional view of how that security relates to other comparable securities. At the same time, it's really important for us to tailor the outputs to the actual position sizes held by our clients. And in that regard, metrics such as days to liquidate or projected price impact, all of these metrics are part of the output because they're really valuable for folks on the risk management side trying to understand what potential risks they have if they were to attempt to liquidate their positions.
There's an expectation in the next couple of months by many that there could be a liquidity-driven crisis. What can portfolio managers and traders do to prepare and evaluate their liquidity risk?
I think there are a number of measures that we've seen folks in the industry taking, and from a market data perspective, it's all about having a sense of liquidity measurement that can be standardized across the spectrum of fixed income securities. So being able to compare a corporate bond to a municipal bond to a structured security on a uniform scale is incredibly important for a multi-asset class manager. In terms of how they test that, the appropriateness of their liquidity risk program, one of the areas that we've seen intense focus is on backtesting. So for instance, analyzing the liquidity profile of the portfolio as of June month end and then comparing that to the future realized trade activity in July can help give an indication that the associated liquidity scores, if you will, or settings or categories were appropriate at that time. Generally speaking, if you're approximating that your security is more liquid than another security, on average you would expect to see more future trade activity. And that's one way that our clients are validating their approaches.
That's fascinating stuff. So thanks for being here today, Rob. It was great talking with you. Again, I'm Kevin McPartland of Greenwich Associates here with Rob Haddad from Interactive Data. Thanks so much for listening.